The recent crypto market crash isn't just a normal correction. Both Bitcoin and Ethereum have plunged to critical levels, and many people have already started panic selling. So I want to tell you, this drop is even more crucial than it appears. If you don't understand what will happen in the next 48 hours, you might miss out on the most important opportunity to position yourself this year. I'm Xiaowu Chelsea, and I specialize in explaining external three-structure institutional trading logic. You need to listen carefully to this next part. First, let's talk about Bitcoin. The weekly structure of Bitcoin hasn't been broken, but the bears have clearly become more aggressive. The trend line below is still holding, so this isn't a reversal, it's a strong shakeout to sweep up chips. On the 4-hour chart, the decline is accelerating, but you absolutely shouldn't chase the drop here, nor is this a spot for random bottom fishing. There are only two professional approaches. First, wait for the price to drop to a key support level and show a strong reversal. Then you can go all in on a long position. Or wait for a rebound to resistance and short when it gets pushed back down. Only these two setups offer a positive risk-reward ratio. Now let's talk about Ethereum. It's currently retracing to the 0.382 level of the Fibonacci sequence, which is actually a healthy correction zone. If Bitcoin holds steady, this will be the most important stabilization point for Ethereum. On shorter timeframes, you also shouldn't chase shorts. Wait for a structural entry, not an emotional one. This is the only way you can survive in a market crash. Third, let's add another promising asset, STRK. As we can see, after a long period of consolidation, STRK is gradually forming an upward trend. We previously placed orders around 0.17 because there was a triple confluence at that level. First, it's the 0.5 Fibonacci retracement. Second, it's the FVG, fair value gap fill zone. And third, it's the support from the order block. Let me briefly explain what these two concepts are so you can better understand why a rebound is likely here. First is the fair value gap, FVG, which refers to a blank area left between candlesticks when the price moves too quickly, resulting in unfilled orders. The market usually returns to this gap to fill it, because that's where institutions have unfinished orders. An order block, OB, refers to the key candlestick area where institutions build their positions before a trend breakout. The last bearish candlestick before a price rises is called a bullish OB, while the last bullish candlestick before a price drops is called a bearish OB. This represents the real cost area for institutions, so it often becomes an important support or resistance level. When FVG, OB, and Fibonacci levels overlap, it becomes the point where institutional funds are most likely to enter. Therefore, it's very normal for the price to rebound quickly after reaching this area. This is a typical structural market movement. If you want to know my actual trading plans for the next 48 hours, including the precise support and resistance levels, entry and stop loss points for Bitcoin, Ethereum, and STRK, as well as our VIP group's daily real-time copy trading strategies, risk alerts, and entry signals, you must join our Discord group. Inside, I provide daily updates on market structure analysis, live trading levels, high probability strategies, reversal signals, and real-time guidance in the VIP section, including how to buy the dip during a downtrend.